So today I'm considering a pretty big change to the way I run the ETF strategy, the one that I've been running for the better part of a year now. The reason I'm considering making a change to this strategy is because I think the structure that I'm using is not actually optimal for what retail traders like myself and perhaps like you should actually be using. Now, in theory, the structure that we currently use, which is a Delta 20 short strangle sold on weekly options, should be profitable, right? In areas where implied volatility outpaces realized volatility, which is basically all the ETFs that we identify using the platform. But in reality, we actually cannot avoid our delta dependency as retail traders. Let me explain what I mean by this. The idea behind the ETF premium strategy is that we want to be selling options where implied volatility has been outpacing the realized volatility, i.e. a variance risk premium has been present over an extended period of time. This is something that's pretty easy for us to identify. And then what we want to be doing is using an option structure to express a view that implied volatility should continue to outpace the realized. So the short strangle, in theory, makes sense with this. At inception, we are delta neutral, we are short gamma, long theta, and short vega. That is the exposures that we want to express that view. But in practice, what I've seen happen time and time again is that the trend in the underlying, the delta, picks up as the stock moves one way or the other. And a lot of the times, my trades have actually turned into losing positions because over the course of 1 week, it's entirely reasonable that a stock could trend up 1%, which is actually a pretty big move in 1 week if you think about it, especially when you're looking at a long-term average, let's say over 5 years. It's rare that a stock moves up 1% a week on average. But if you just look at any given week, it does actually seem to happen. Even though the realized volatility on a daily basis itself has been quite low, the stock can trend and does trend is the reality of what I've been seeing. So I wanted to make a change here because I'm getting tired of losing because of delta purely, right? Especially to the upside, because a lot of times when a stock realizes a high level of realized volatility, it's to the downside, right? The whole idea of stocks going up like an escalator and then down like an elevator basically means we should be seeing low volatility to the upside and high volatility to the downside. If we're selling options on SPY, we should be minimizing our losses to the upside from volatility because we know that we're going to take losses to the downside and we need to be capitalizing on these winners as frequently as possible, these situations where volatility remains low, in order for us to actually be able to weather those storms of high volatility when they actually occur. If we're not, taking bases when we can, eventually, I don't know, I don't actually have a baseball analogy I'm going to use. I try. I don't even really know how baseball works. I'm basically saying we should be winning when we should be winning because we will take hits and we're supposed to be financing those hits with our wins. So what's the change that I'm considering making? The change that I'm considering making is adding a bit of delta to my view. And the way that I would go about doing this is by selling a bull put spread on a 30-day expiration. Here's the core idea behind this. If stocks go up, vol should be low and I should make money. If stocks go down, vol should be high and I should lose money. That should be the two situations, pretty much. And it's because of a concept called spot volatility correlation. It's the whole up like an escalator, down like an elevator thing. If volatility is going to be high, right? If we know if volatility is high, we can assume stonks go down. If volatility is low, we can assume stonks go up. And our view should be in alignment with that, in my opinion. So that's the change that I'm making. Rather than doing both sides where I sell the calls and the puts, I'm just going to sell the puts. And rather than doing weekly options, I'm going to do monthly options. Now, the reason for this change is because I think on a weekly basis, once again, the implied movement range is like 1%. And I think it's totally reasonable for things to be up or down 1% on a weekly basis. But if you sell the monthly options, you're maybe selling 3% moves now, 4% moves. And on a month-to-month basis, how often is the S&P down 4%? I don't know, maybe 4% of the time. Something like that. I think I did a little study. It was like 4 or 5% of the time that you can see a move like that. And that's where you break even a lot of times. If you're doing, let's say, a Delta 20 and a Delta 10 bull put spread, you are basically breaking even at the 4% move mark and you cap your losses at like an 8% move mark. And so you see a max loss maybe like a couple percent of the time. You see moves around 4%, 5% of the time, and the rest of the time you make money. And this makes a lot more sense to me than the way we were currently structuring things. The long-term expected value theoretically should be similar or slightly worse doing the bull put spread. But I think in practice, it will actually show to be the better structure to trade. And I think it just comes down to the fact that in practice, we have this delta exposure, we have imperfect delta hedging. And if you look back at the last 5 years, the bull put spread has significantly outperformed the strangle. And even though, in theory over 15 years, this and that. I think it's too big of a window for us to be looking at, because the reality of retail trading is nobody's going to sit through a 3-year drawdown, which is something that would be entirely possible over the last 3 years with the Strangles, because the market has trended so hard. So that's the main reasons I'm considering these changes. I wanted to document pretty much how I was thinking about things. So this is just a one-take video talking about my idea here. I'm going to start running it. So today I put on trades on maybe 5 ETFs that are out of the money bull put spreads, selling the Delta 20, buying the Delta 10. 30 days or so, 37 days to expiration. I wanted to use the monthlies for liquidity. I don't plan on delta hedging them at all. I'm just going to let it rip and see how it goes. My understanding is that if things are good, if vol is low, I should realize a max win on pretty much all of them. And if things are high vol, then I should realize a loss on all of them. Now, one last thing I'll mention is in terms of taking profit on these, here's an interesting thing that I've been thinking about. Let's say we start to get that bullish uptrend. Delta 20s maybe now become the Delta 10. And so in this case, because they're also further out of the money now, we're not just getting like this theta decay, there's an impact because of delta. And I think in this situation, when we get to maybe like a 70% profit, something like that, I'll close that out and roll into the next one. And I'll roll up my strikes so that it's like back to like Delta 20. So I may not actually be holding these to expiration. They might be closed out much earlier if things rally hard. On the downside, I don't think that I will be rolling the strikes down if they get tested or something like that, because on average, stonks go up. And so let's say there's 15 days left and we're down 1 or 2%. I'm not going to be doing anything about it. It's actually doing that I think has cost a little bit of money, because the weeklies you can think of as restriking on a weekly basis. I think constantly chasing around that little bit of price movement maybe is doing a little bit more harm than good, unless you have a really large number of trades on. Like if you're doing every ETF, maybe it doesn't impact you as much. I'm just trying to keep it real. I'm trying to find what actually will work best. And this is what I've landed on as a worthwhile hypothesis to test. So I'm also going to be doing some back testing for this. I'll let you know how that goes at some point whenever I release this. But let's see how this first month of testing goes. And yeah, I'm feeling pretty good about it. All right, everyone. Thanks for sitting through this monologue about trade structures. And I hope you found it useful. Take care.